Hey guys, don't be alarmed. I just need to do a bit of a sound check. Good morning. Test, test, test. Nice. I see you in, I think, 2 minutes. Hello guys. Wonderful good morning. Please join me. Super. Hello guys. Welcome back. Welcome back. Guys, let me start. Yeah, well, wonderful good morning. Let me start with a couple of logistic things, important things before we hop into our actual content. I sent yesterday evening a message into the group with a couple of, I think, pieces of information that might be relevant for your psychological well-being. And I want to be on the record on YouTube on a publicly available channel and just say this again for everybody who might still not be in our Telegram group. If you want to be, go to announcements on Canvas. I've posted a link. Please join. So I remind myself sometimes that not every student who is in my course is a huge fan of finance, and it is perfectly fine. I understand that you have not picked this course because you choose it as an elective. It is not an elective. So many of you, hopefully not too many of you, but quite a few of you might be here because simply the curriculum forces you to be here. So I'm perfectly comfortable with accepting that not everybody wants to become a finance crack. That is absolutely okay. It's absolutely okay if you say, I want to later on do marketing or logistics or supply chain management or business information management. I understand that. I'm not saying finance is the most important topic ever. So it is valid to say, I just want to get through this course. So I want to say a couple of sentences to students that might be right now struggling, that might be feeling a little bit overwhelmed, that might maybe just not enjoy this. So the first thing is, after today's class, officially we will have finished half of our lectures. So very simple logic, and I will apply a little bit more accurate logic in a bit. Simple logic suggests that, well, the moment we're done with half the lectures, there is a maximum of half the same amount of content left to be discussed. So that's the first thing. There is not all that much left anymore. The reason why I said this is only rough logic is the specifications of the course. When I took over the course many years ago, it was one lecture a week and one workshop a week. And I noticed that students were struggling mightily in the workshop because one lecture per week for all our content is not enough. So that means without having been exposed to properly the theory, of course you're struggling with the workshops. So I immediately doubled the lectures. I said, I want 2 lectures a week and a workshop. So that gives us plenty of time to discuss everything in great detail. And it also means I don't really need twice as many lectures. So typically we will finish the content well before the schedule suggests, lecture-wise at least. That means after today we will actually be well beyond 50% complete. Number one. Number 2, if it turns out that in the end we have a couple of lectures left, even though I have no new content, we can do whatever we want. So I rarely cancel classes unless there's a valid reason. So I'm very open, as always, to your suggestions. If you say we want to refresh a certain chapter, we can do a Q&A, we can do all kinds of things. So that's a little bit dependent on your input. And of course, if everything is clear and it only comes down to you need more time to practice, then in this case, I would also cancel classes in the end of the course. So that's number 1. Number 2, I can understand that what we have discussed so far could be a little bit overwhelming because it is one big narrative, it's one big storyline. And if you basically fell off the narrative train early on, let's say you're struggling with what's the tax shield, then everything after this must feel challenging even more than it really is. So this will, after today, change. And the reason why it changes is we have still plenty of content, but this is more, everything we still have to discuss are sort of almost standalone topics. Of course, we can connect them to the world of finance, no question there. But for you, as from the student perspective, these are chapters that you can almost study standalone, independent of each other. I would not really sort of recommend this. I want that you see the big picture at all times, but it is possible. So far, if you look at the chapters, they make sense together. This will change a bit, so you can really then say, I study now specifically chapter 17 valuation, or chapter whatever, 22 I think, options or something like this. So where you can really say, maybe the beginning of the course was a bit tricky for you, but afterwards you can really selectively study chapters for your mindset, for your peace of mind. You could say, okay, I have committed a lot of effort now to chapter 17 valuations. I'm basically the half god of valuation now. Check this chapter. If it comes on the exam, I will ace it. So the second part of the course will allow you to really finish chapters in your studying, whereas the first part makes sense together. That's important. What else is important? I said in my message yesterday, everything, all the chapters that we still have left to discuss, students typically don't perceive as more difficult than what we have done already. So I find it gets easier. There's one exception, as I said in my message, options. However, and that I did not say in my message, many years ago when I started discussing with RSM, should I work at RSM or not, the department asked me, can you prepare sort of like a sample lecture just for us, department members, so that we can see what kind of teacher you are. Pick any topic you like, it's more about how you explain and how you interact. And I selected the chapter options. And after my sample presentation, the department told me that was very nice. We will call you in 2 weeks and tell you if we want to hire you or not. And I think 2 hours after I had left, I got the call, we really want you. The reason why I'm telling you that is not because I like to brag, even though I do like to brag, but I want to drive home the point that I think, and certainly my department thinks, I can explain options really well. So it is not a super easy topic. It's not a little bit blah blah. It's quite hardcore. But it can be explained crystal clearly. There's a little bit of math involved, which can be explained crystal clearly. I have beautiful slides, step by step, every single number color-coded, so we will build it up slowly. And for options, we will take more than one lecture, simply so that we have the time to really do it step by step until I'm convinced every single student understands it well enough. My goal is, I don't care about your grades at all. I only care, do you pass or fail? I want as many students to pass as possible. If you want a 10, you will need to sit down and study. My objective is helping students pass. So that is my focus. So if at this point you are overwhelmed, a little bit exhausted, we are at the middle of the course, I can imagine this is psychologically probably a bit of a slump and it's difficult to be motivated. Just don't drop out, don't give up, hang in there, okay? The worst is behind you. Everything we have left is relatively straightforward. The parts that are not straightforward, I think I can explain really well. And the chapters left are standalone chapters that you can really consume almost individually. So if you chat to other students, hey, do you go to class? And the student says, no, because after lecture 3, I sort of fell off the narrative train. So I wait till the course is finished and then watch everything. Please tell them the time to check in again, should somebody have in a way dropped out, would be after today's class, where we start basically turning the page and starting with new content. That would be a great opportunity for somebody who has said, For now I drop out to jump back in. This is how that's gonna go down. Hang in there, guys, okay? Almost done. Are there any questions? Is there anything on your mind that we need to talk about? Anything that I need to explain? Anything before we hop in? Okay, sorry, one last thing. That has nothing to do with the fact that I'm your finance teacher. That has to do with the fact that I'm the guy with a high-end TV studio at home. So I spoke to your SR reps. By the way, thanks guys for the meeting. I've been thinking a lot about what we've discussed. I thought that most of your courses currently are taking place on campus. So I thought, oh, the students will love this, that at least this one big course is online, it's more convenient, you have the recordings, and you still meet on campus. And your SR reps told me that basically most of your courses, if not all of your courses, are online. And we discussed a little bit how overall students are holding up, mentally, not content-wise. And I got the sense that not everybody is super well connected, not every student knows a ton of other students. So I don't know how that is for you. I'm used to being on campus, constantly chatting with people, and all of a sudden I'm all the time alone. So if a student would tell me I feel kind of lonely, I would be able to relate 100%. So I just wanted to drop this. I think I mentioned it before again. If you have an idea for some sort of online event in the light of COVID now, some sort of online event, not finance, but something fun, something nice, I don't know, where we can connect a bit, chat a bit, yes, get drunk if need be. I mean, just let me know. I'm happy to help with studio tech and stuff like this. We have done 2 pub quizzes. I think maybe some of you have joined. I would be happy to schedule something after the course, maybe a bit before Christmas, couple of hours, crazy pub quiz, 1 million beers. If you want something like this, I would love to be involved. And if it's a pure student event, I would still be happy to help you with the tech at least. All right, so don't think that you're completely alone in this shit. This is nasty for all of us. If I can help you somehow in this social dimension, I would just need to know, and I would be more than willing to help in any way I can, okay? Enough of this, let's hop in. This is the last chapter that I would classify as relating to capital structure. So today on the agenda is dividends. We have spoken quite a bit about dividends. You've heard me say a lot of things like you can pay this out as a dividend. You've heard me say you can put your bondholders at a disadvantage by paying out an extra cash dividend in times of financial distress. We have discussed what dividends really are, paying out a part of the profits that the company has generated and stored in the retained earnings, and you pay it out to your shareholders in the form of cash. Sure, but we need to still address what should a firm do. Not what are they doing, but what should they do? Should they pay out excess cash? Should they leave the excess cash in the firm? Think pecking order theory, to use it as internal financing for future projects. Or number 3, should the company use excess cash to buy back its own shares? So not Microsoft has too much cash, what should they do? They could invest in shares of, let's say, Apple and hold it as an investment. That's not what I mean at all. But Microsoft, if they had a lot of excess cash, profits, high retained earnings, they could say, let's buy back shares, but our own shares. So Microsoft, the firm, could buy back its own shares, Microsoft shares. Why would anybody do that? Well, if I'm Microsoft and I buy back my own shares, what would happen? The number of shares outstanding would of course decrease, and that means whatever profits the firm will generate in the future will be divided over a lower amount of shares outstanding. So in the long run, that could increase the earnings per share, simply because there are fewer shares outstanding. So broadly speaking, that are the three payout strategies that we have to discuss. What should a firm do that's performing well, that's making profits, therefore building up retained earnings, so equity goes up? What should they do? Should they pay it out in the form of a cash dividend? Should they retain the retained earnings basically in the firm and use it as internal funding for future projects? Or number 3, should this money be spent on buying back its own shares? Why? To reduce the number of shares outstanding, so that there might be more benefits for the shareholders in the future. Full disclosure and a little bit of a spoiler alert, this all will lead us to Modigliani-Miller proposition 3. if you in your mind have saved for now, Modigliani Miller is difficult, please don't think this. Proposition 3 is very, very easy to grasp. It is not a mathematical concept whatsoever. It's basically one of those things where we finance people have invented a big sounding term to make ourselves look more important, I think, than we are. So none of that is going to be complicated for you. Let's hop in. Let's hop in. I have
one quick question.
Of course, by all means, shoot.
It's probably like a kind of a technicality, but assuming that all shareholders of a firm want to keep their shares, how would a firm say like convince or like buy back hundreds of thousands of shares from shareholders?
Yes. It's a good question. So technically that would work like this. I mean, if you are a shareholder, I'm the CEO of the company, and we have decided to pull off a share buyback, as it's called, meaning that we, the firm, try to buy our own shares. Logically, we would have to find shareholders that are willing also to sell, right? That's sometimes a little bit difficult for people to imagine that for every shareholder that says, I would never sell my shares, I can easily find you a shareholder that says, super, take my share. Because our expectations would never be perfectly aligned. I don't know how you feel about Bitcoin. I feel sometimes, or feel, I should maybe not say feel, based on some sort of reasoning, I come to the conclusion that Bitcoin does not really have a fundamental value. So whatever number I see as a price for Bitcoin, I'm thinking it's probably too high. But for this opinion, I can pull out any number of students that say Bitcoin is the shit, you should get it, it's the best investment ever. So people rarely agree on future developments, what the future is gonna bring. So I, as the CEO, or we as the company, would simply then say we wanna pull off a share buyback, and this is the purchase price per share that we offer. And then we would simply wait who is willing to sell. That's roughly how that would look. Okay? Okay, let's hop in. I have prepared, of course, a slide set. You can find it on Canvas. As usually, I upload it on the evening before, so you can, of course, find it there. Let's hop in. It's a bit of a recap to set the stage. What we have discussed. Well, we have talked Modigliani Miller every which way. By the way, since I saw, sorry guys, since I saw in our Telegram group, there's one student that has sort of as a nickname on Telegram MM, and somebody said, are you Modigliani Miller? And I've never really made this clear. I just want to say that now on the record. Modigliani Miller is not one dude. There are two different guys that are their last names. One is called blah 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 Modigliani and the other one is called blah 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 Miller. So there are two different guys, okay? So nobody is Modigliani Miller, there are two people. So we have discussed, or we have tried to develop a framework how capital structure policy, so the mix of debt to equity, impacts the value of a firm. And we've gone through different stages to make it a little bit easier for us to approach this complex topic. So we have discussed how does this work? Number one, in a world with perfect capital markets. That means no frictions. Taxes are a kind of friction. So when I say with perfect capital markets, we're talking about Modigliani Miller, proposition 1, no taxes. Then we have said there are imperfections such as taxes, blah, 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 bankruptcy costs, agency costs. And we came to essentially three different conclusions. In a world with perfect capital markets, also no taxes, capital structure should be irrelevant. Modigliani Miller, no taxes, proposition 1. If we then relax the assumption of no taxes, so we recognize there are market imperfections, to the very least taxes, corporate taxes, then we conclude if a company increases its leverage, if the amount of debt in the capital structure goes up, then this will increase firm value. Why is that? Because of the infamous tax shield. We end up essentially paying a lower amount of taxes. And number 3, if we look at a more realistic representation of the real world, we have capital markets, but we have to recognize that there are taxes, that there are bankruptcy costs or costs of financial distress. There are agency costs. So what was our conclusion then? Well, a firm can increase its value by increasing the amount of leverage, so by increasing the amount of debt in capital structure, but not indefinitely, like in Modigliani Miller, proposition 1 with taxes. Here, in a setting that is more resembling the real world, first firm value goes up as you increase leverage, but only to a certain point, and then firm value will decrease again, will go down again. And that is, of course, why is that? That is because of costs of financial distress and agency costs. And now we turn to chapter 18. Again, I said it a couple of times before. I use the chapter numbers from the third edition because my impression was most of you have the third edition. I'm basically talking about the dividend chapter. If you say, how do I know which number applies? Well, I always use third edition. Please go check out workshop slides from the first workshop. Celine has a beautiful overview where you see all the chapters we discuss and the numbering for the third and the fourth edition. Okay? So what are we gonna do basically today? And if we need a little bit a second lecture this week, we are gonna examine how, and actually even if, dividend policy of a firm has any impact on the value of the firm. And I want that it is as tangible for you as possible. I don't want that you think this is blah, 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 blah. What does it mean when somebody says dividend policy? When I use the term dividend policy, what I mean is the choice that the firm makes. Should I pay out excess cash? Should I retain it as internal source of financing? Or should I use it to buy back our own shares? Whatever we choose, that would be referred to as that is our dividend policy. Brief side note, real world stuff. How much dividends did Netflix pay so far to its shareholders since Netflix exists? I want to hear the accurate number.
0.
Excellent, excellent. You're absolutely right. Netflix has never paid a single cent dividends. That's kind of weird because intuitively it seems like for a shareholder it would be valuable to be invested in a firm that constantly pays out cash. Isn't that what being a shareholder is about? That I earn regular dividend income, yet here we have a company, Netflix, that many people consider a great company, dominates the streaming market and. They've never paid a single cent. How is that possible? So if you're wondering about this, that's what we're going to discuss today. The structure will be, I will give a little bit of an introductory speech, point out all kinds of things. And as always, I'm convinced it's best to look at an example. So I have a stylized example here, a very specific company defined by a couple of financial parameters. And then we play out each of the three scenarios. What would happen from the shareholder perspective if the firm were to pay it out, if the firm were to leave the money in the firm, or if the company uses the money to buy back its own shares. So this will be simply a step-by-step analysis of three scenarios.
Sorry, can I quit a quick question?
Absolutely.
Yeah, I just want to ask if this topic adds to what we already discussed, just organize it in my mind, or it's like completely unrelated to what we discussed.
No, so it's a good question. Nothing we discuss in finance is completely unrelated to each other. So it doesn't matter, even if we talk about options, a financial instrument that can be traded, bought and sold, you can use it for speculation. We can of course connect it to a balance sheet and so on. So nothing is ever completely disconnected because then it would not be a finance course. I would say this is the last lecture that is very obviously still part of the narrative. And the main evidence for that is today is gonna boil down to me saying, ta-da, and this is proposition 3 of Modigliani-Miller. Okay, so for your note keeping, this is definitely part of the whole capital structure conversation, definitely a part of Modigliani-Miller, no question about it. Okay? Super, okay.
May I ask a quick question as well?
Oh, of course, always.
So in the last exercise from the workshop, we learned that the bankruptcy cost, we would simply subtract it to the value of a firm, to the value of lever firm. Yeah?
Yes?
I wanted to ask for the agency costs. Does that work the same way? We just subtract it at the end?
Yeah, absolutely.
Again, it would be a value that is given to us in the question.
Yeah, I mean, we have to, so in my response, I have to consider now two different answers. How do I answer a student who might think about the exam versus how is it in the real world? If that matters on the exam, obviously we have to provide the information somehow so that you cannot be expected to come up with that on your own. In the real world, nobody will give you that. So you would have to then calculate, estimate, or I want to be more honest, guesstimate these costs yourself. And I'm very grateful for your question, Alberto, because Again, please note, I don't want that you think everything I show you here is purely awesome and above all criticism. Then we set up our beautiful net present value calculation. And just the point that Alberto raised now, how about agency costs? Let me zoom in on one specific agency cost. Or not agency cost, sorry, indirect costs of financial distress. Loss in revenue because customers are more reluctant to do business with your firm if it already appears financially distressed. We set up our beautiful net present value calculation. How could I possibly know how much on future revenue I will miss out because customers don't want to do business with my firm but with some other firm? So I have to really admit, and I really want to stress this, that you let this sink in. We are really in the realm of almost guessing these numbers, okay? So please don't think, because you're looking at a very accurate looking Excel sheet, that these numbers are very accurate at all. How could they possibly be? We cannot predict the weather for more than 3 days, and less so in the Netherlands. So how could possibly anybody predict the loss in revenue in all the future years because customers do business with other firms rather than us? So please don't succumb to this fallacy thinking an Excel sheet is by definition accurate. It's as accurate as the input parameters that you use. Many of the input parameters that we have to use are guesstimates at best, and therefore every result that you get should be taken with a grain of salt. All right? Okay, so there are a couple of logical considerations for us. So we can conclude firms should always invest in projects that yield a return greater than the minimally acceptable hurdle rate. Brief side note here, just very briefly. I use here the word always. That's something that you will read in many finance books. I hope that by now you're very skeptical about this word. Why? I can think of plenty of projects that yield returns greater than the minimally acceptable hurdle rate that I would never invest in. Think of my example. You're a baby food company, you're producing and selling baby food. One project, I guarantee you, that will yield a higher return greater than your hurdle rate, the hurdle rate of a baby food company, would be to produce not only baby food, but assault rifles. Because obviously the profit margin on weapons of war is absurdly high. Or if you produce drugs and sell drugs illegally, highly positive net present values. Human trafficking, high positive net present values. So obviously the word always here, you have to really be very, very skeptical about it, okay? Don't forget about, first of all, the law and also ethical values, okay? Don't make the mistake, or what I would think is a mistake, of running a firm completely free of any ethical backbone. Okay, there could be problems though. So this seems like a meaningful advice. Yeah, try to invest in, let's say, ethically sound, positive net present value opportunities if you have the money. However, it could very well be that there are not sufficient investment opportunities available whose returns exceed the minimum hurdle rate. So that means even though you might have the cash, you might have the capital to engage in positive net present value opportunities, projects, if these projects are not available, what are you supposed to do then? Then you're sitting on a pile of cash, and then what? So if that is the case, firms would be better off paying out the excess cash to the shareholders. Why is that? Why would it be then better for the firm to pay out excess cash to shareholders? Well, because shareholders might be able to do something that's value increasing, even though we as a firm might not be able to do so. So how can we explain this? Well, investors could theoretically be able to generate much larger returns by investing the money we pay out, the excess cash that we ourselves cannot invest properly. They could maybe invest it elsewhere. So if we as a firm do not pay out excess cash, our investors, our shareholders might penalize us, might punish us. How? Well, selling the shares, driving down the share price, reducing the firm value, for example. So why would they want to punish us? Because of the opportunity costs. The shareholder thinks, now wait a second, the firm is sitting on a pile of cash, they are not investing anywhere. Sure, there are no investment opportunities for them, but I have all kinds of investment opportunities. So by all means, pay out the cash to me so that I can go and act. And if we then don't do this, the shareholders would punish us for the opportunity costs. So the investment opportunities that they themselves now have to forego simply because we don't pay out the excess cash. And secondly, and that connects a little bit to the previous question, how is this connected to our capital structure conversation? Look at the second blue bullet point. What happens if I, as the manager, do not pay out the excess cash? Sure, the shareholders might punish us, but what else could happen? Well, managers might end up destroying value. How? Why would I, as the manager of our firm, the firm of which you are a shareholder, how would I be able to destroy value? Discretionary spending. Give me an example what I, as a CEO, could do that would be value destroying and that you would label discretionary spending. I want a lean example, please. Give me an example, guys. Unmute yourself, shout.
Expensive dinners.
Expensive dinners, good example. Yes, there's a lot of cash in the firm. I'm a CEO, I want to feel important, so I constantly go in Rotterdam to restaurant Parkheuvel, simply because, well, the cash is there, I'm important, I do all my fancy business dinners there instead of McDrive, let's say. My example was, I don't know if you remember, I would in my office immediately get a massive oil painting of myself. So that's what we label discretionary spending, basically spending money for which the CEO does not need anybody's permission. A lot of this spending will be meaningful for the firm, but not necessarily so. The CEO, the management could act in a very wasteful way and spend money on something that does not have a positive net present value and that clearly would be value destroying. So it is not necessarily only a good thing to have a lot of excess cash because it could be wasted. The keyword would be discretionary spending. To connect it to what we have discussed, think about the slide I showed you last week, the advantages of debt financing and the disadvantages of debt financing. And if you look at the side disadvantages of debt financing, I think the second bullet point are agency costs of debt. And one aspect that I point out is discretionary spending. Okay, so where does this leave us? It leaves us with having to point out that firms must make a decision. They need to decide how much to pay out to the shareholders and in which form. If the firm says, yes, we want to pay out excess cash, then they still have to make another choice, two options. Should I pay out cash? So should I, the firm, basically give you really straight cash, or should I try to benefit you from our excess cash by repurchasing our own shares? So that would be the decisions that have to be made. The choice how to return this excess cash to the shareholders depends on all kinds of different aspects. It depends on the shareholders' preferences and characteristics. It's a bit early, we might not be able to get to this today, but you can already make a note here. It pops up very late in this slide set. Clientele effect. Okay, we will talk about it some more, but you can already make the note, this is what is meant. Or it depends on whether the increase in income of the firm is permanent or only temporary. There's a behavioral explanation. I don't know about you, I think you are people like me essentially, and we have something in common. We get used to things very quickly. So for example, if you come home after work once and you bring your partner a beautiful bouquet of flowers, I have very little doubt that your partner will be very moved and will be very happy with you and, oh, that's so sweet that you thought of me and after work you bought beautiful roses for me. Cool. If you do this every single day, let's say for 2 weeks, and then one day you come home after work with no flowers, what do you think will happen? I mean, I'm now, I don't know, guessing of course, I don't know your partner, but I think the response would be then, where are my flowers? So what I'm trying to say is, people get used to a higher standard very quickly, and if then this standard is taken away, they don't say, well, it was nice as long as it lasted, the 2-week phase where you always brought flowers for me. They will say, where are my flowers? I want my flowers. And that is true for dividends as well. So if we have a temporary increase in income, so a temporary amount of excess cash, and we say, good news guys, we have a lot of excess cash, seems only temporary, but let me pay it out as a cash dividend, shareholders will not perceive it like this. They will react more like your partner in my example. The next year, if this temporary increase in earnings is gone again, and you reduce the amount of dividends because there are not enough earnings, the shareholders will not say, well, we are still grateful for the extra dividends from last year, so good job. They will say, how is this possible? Last year you increased the dividends and this year it's less? That's not okay. Okay, so that is what is meant here. If an increase in earnings, in income, is only temporary, increasing the amount of cash dividends is not a good idea, but for behavioral reasons, because shareholders immediately get used to this higher level of dividends, and if you then take it away from them next year, they will punish you for that, okay? I apologize to any partner that you might have who would handle 2 weeks of flowers really well, even if you then stop, of course. What is the overall objective of all of this anyway? The objective has not changed one bit. We are still, as always, trying to maximize firm value. This is, I'm gonna introduce you to a model that was a starting point of dividend considerations that we don't use anymore. So it's a bit of a historic detour, it's very brief, it's very easy to understand, and you immediately see why it doesn't work. So before Modigliani and Miller helped us understand capital structure and by extension dividends, there was a model called the Gordon growth model. It basically builds on this metaphor of a bird in the hand is better than, I don't know, a bird somewhere else. What does this mean? This here means the value of the firm at T0, so what is the value of a firm right now, equals. This here simply means the sum of, so there are all kinds of terms. What does this mean? The value of a firm right now is equal to all the future dividends, so the dividends of next year, in 2 years, in 3 years, in 5 years, in n years. What am I doing here? I'm simply discounting it. What does this whole thing mean? The value of the firm is the present value of all the future dividends that the firm will pay out. That's what it means. So what, if this were true, if this were sort of a correct model, we could make inferences, conclusions from that. We could, if this is the case, then paying out more dividends sooner would increase the value of a firm. Why? Because the more in the future I go, the more brutal the discounting will affect the present value. So it's then better to pay as much money close to T0 as you can, because the discounting over more years will seriously drive down the present value. So if the Gordon growth model were to be meaningful in the real world, the conclusion would be firms can increase value by paying out a lot of money relatively sooner rather than less money later. Is this important for you? Well, not really. Modigliani and Miller showed that this is not correct. And I will explain, of course, why. This is a bit of a spoiler now, I'm perfectly aware, and I am also perfectly aware that I need to do some more convincing to show you that this is really the case. This is called Modigliani-Miller Proposition 3. What does Proposition 3 say? It's not a mathematic model, it's really a statement really. In a perfect capital market, while you keep your investment policy fixed, I will explain in a second more, the firm's choice of dividend policy is irrelevant and it should not affect initial share prices. Let me elaborate what this half sentence in between means. So in a perfect capital market, dividend policy does not matter. It's completely irrelevant if you keep all the money, if you buy back shares, or if you pay out all the money as an extra cash dividend. Should not matter. Proposition 3 is also referred to as dividend irrelevance theorem. What does this half sentence mean? Whilst keeping the investment policy fixed, it means we have to assume for this to check out that the firm is not changing its asset composition. And that's just finance blah blah for they are not buying any new assets that will change the future earning much. Because obviously then the setup of our sort of exercise would change. So assuming that your asset side remains unchanged, dividend policy in perfect capital markets should be completely irrelevant. Like I said, I will try my best to convince you that Modigliani and Miller have a point here. again, disclaimer, please note, we're talking about Modigliani-Miller. So of course, you have to be careful in translating that one-to-one to the real world, because we are making the assumption of perfect capital markets again, meaning there are no taxes, there are no transaction costs, there are no bankruptcy costs, no agency costs, and so on. Okay? So what we will do next is, I will do my best to convince you that Modigliani-Miller proposition 3 in perfect capital markets really holds. Then of course we have to acknowledge, well, in the real world, all of this is not the case. So again, we will then relax our assumptions and explain how relaxing our assumptions impacts our conclusions for the real world. That is roughly our plan. Is there a question?
Yeah, sorry, I have a question.
No need for sorry.
Because I'm a bit lost about the proposition frameworks. Are they situations or just theories?
Okay, so I'm not too happy when somebody says, is this sort of like the real world, or are they just theories? Gravity is just a theory as well. I mean, I'm not gonna say now, do a test and see how well that holds up. A theory, the term theory is in science used very differently than we use it when we're having casual beers. Let's say you and me agree on, hey, after class we grab beers, and a couple of other students say they join as well, but one student does not show up on time, and we're chatting, where is the student? He said or she said they will show up as well. And then you might say, hey Flo, you know, my theory is that he just, I don't know, took a nap and overslept or something like this. Yeah, when we are having casual beers and you say, my theory is just overslept, makes perfect sense. In science, in our setup, to call something a theory, it has to be established, explained, and tested and retested a million times. That's true for gravity, that's certainly true for evolution. So in a scientific context, please don't say it's just a theory, because theory is the strongest conviction you can have about something, okay? So that's the first thing. And now to the second part of your question, what about the propositions? How do they relate to the real world? Don't forget why we are talking about them. I'm not showing you these things, proposition 1, 2, and 3, in a world with or without taxes, because you can take it and apply it in the real world to your monetary benefit. The reason why we need to do this is we need to slowly build up our understanding of how the real world works. And the real world is so messy, and there are so many specific details that we would actually have to consider, that if we were to attempt to understand the real world without any warm-up, we would not stand a chance, okay? So very, very, well, I almost want to say nothing of Modigliani-Miller can be used in the real world immediately. That's also not the idea. The idea is to simplify the real world with all kinds of assumptions, no taxes, no transaction costs, no bankruptcy costs. Then this situation is small enough for us to understand. And then we say, okay, but the real world is different from our assumptions. And then bit by bit we relax the assumptions so that we then can approach understanding of the real world. So look at this as it's like you and me go to the gym and we have chest biceps day. Then we will start warming up. That does not mean that we only end up bench pressing 50 kilos. That's just warm up. Understanding the real world is then like actual workout with bench pressing 110 kilos. Okay, so this is really warm up so that we may understand the complex reality better. Does it make sense?
Yeah.
Nice. Super. Okay. So Modigliani-Miller argued that you cannot look at dividend policy in isolation. And in isolation, I mean basically from the rest of the balance sheet, from the rest of the financial stuff that's going on in the firm. I will elaborate, of course. Why? Dividend policy is a residual of the investment policy firm. Again, don't be intimidated by the language. It's just complicated finance blah blah for something that's quite simple to understand. What does this sentence mean? Dividend policy is a residual of investment policy. Well, investment policy is the finance language for a firm has to make up its mind in which kind of assets, in which kind of projects to invest. Now yeah, and if then there is cash left, that's what residual means, you can start considering paying that out somehow. So what does this sentence really mean? After you have figured out how much capital you need out of your retained earnings for financing beautiful assets, after you have figured that out, you will have some money left, a residual, which theoretically could be used to, for example, pay dividends. So whatever you decide to do with this excess cash happens after you have figured out your investment policy. That is what this means. Okay? So the reason why the investment policy comes first is the investment policy, the firm's actual investments, that is what generates our returns. And that is therefore what also impacts, generates the actual firm value. Okay? So, and like I'm saying here, to the extent that the investment policy is unchanged, fixed, as I've said in proposition 3, a firm cannot increase its value by increasing the dividends. Again, we have all kinds of assumptions, no agency costs, managers can act in the interest of shareholders, they do not waste money, all unrealistic at this point. So I'm trying here in many words to make a relatively simple argument. Well, I'm not Modigliani Miller. You cannot look at dividends alone. You cannot simply say, let's talk about dividends and ignore everything else. You have to first acknowledge the fact that dividends comes second. First, the company has to figure out in what they want to invest, the left side of the balance sheet, the assets. After that is done, then they can turn to thinking, what should we do with excess cash? Because only then is it clear if there is excess cash. Okay. Proposition 3 makes additional statements. So if we say the assumption is the investment policy is fixed, then according to proposition 3, the magnitude of the payout does not impact the value of the firm. So not only does it not matter what we do, pay out, retain or buy back shares, also the magnitudes would not matter. A lot of dividend versus a slightly lower dividend would also not matter. And the form of the payout, as I've said, dividends, share buybacks, doesn't matter either. So when this is referred to as Modigliani-Miller proposition 3, aka dividends irrelevance theorem, the term irrelevance is really all-encompassing. It doesn't matter what you do and it doesn't matter how much you do. Again, the evidence I still need to provide. So this is now a relatively long example. Let me check the time. It's now 45. I think it would be a great break point here before we do this example, going through the 3 different scenarios, have a 10-minute break, and then we reconvene and I walk you through this. You will see it's absolutely not rocket science. And today, all of this is gonna lead us to, like with leverage, in Modigliani-Miller world, leverage doesn't matter, capital structure irrelevance, as we've said. Our conclusion here, and with leverage, we concluded this because we noticed, wait a second, a shareholder is not dependent on the firm to set a certain leverage ratio, because the shareholder can recreate any capital structure that he, she or they desire. Our conclusion here, spoiler alert, is gonna be dividends don't matter. Why not? Because a shareholder can artificially create any amount of dividends that he or she or they want. And that is called homemade dividends. If you're now thinking, homemade leverage was kind of challenging and there's another homemade dividends now. This is the perfect example. This is the reason why I very often point out this is just complicated finance, blah, blah, for something very easy. So no need to be worried, no need to be alarmed. You will, when I show you what homemade dividends really are, you will say, yeah, that's nothing, okay? So nothing to be afraid of. Let's have a break. Let's reconvene in 10 minutes. I see you in a bit, guys. Hey guys, slowly get back to me. Finish grabbing coffee, toilet break. We continue in a minute. So guys, come back to me. Come back to me and let's do some dividend considerations. Nice. Hello again. As I've discussed, as I've mentioned, we are going to do now an example, stylized a little bit, simplified a little bit, just to drive home the core message of why do we have to talk about proposition 3. So in essence, I'm going to try to provide now evidence, logical evidence for proposition 3. I've just told you essentially the conclusion. I need to deliver evidence. Let's. So we are looking at a firm that is an all equity firm, just to make it a bit more easy for us. They have 10 million shares outstanding. Brief side note, sorry. Don't forget, all equity, there are 10 million different ways how I can phrase this. I could say it's a firm that has zero leverage. I could call it an unlevered firm. Okay, there are many, many different ways how I can phrase this. All of it means the company has no debt. The company has 10 million shares outstanding, and at this point they have $20 million in excess cash. So that's excess cash here being defined as the net income that the firm has available after undertaking all positive net present value investments. That's why we can call it excess. They don't need it because there's nothing they can really do with it in terms of investment opportunities. The company expects to generate free cash flows after tax of $48 million per year for all subsequent years. What does this mean? In perpetuity. What does in perpetuity mean? Forever. This is not as unrealistic as it might sound. To the very least, I can make a legal argument now. Accounting law knows the so-called going concern principle, which means you prepare your financial statements under the assumption that your firm will continue to operate. So in that sense, at least it checks out. Okay, 10 million shares outstanding, all equity, 20 million cash. We don't know what to do with it. The company already every year will generate $48 million more every year forever. There are a couple of considerations first before we hop into the actual 3 scenarios. So we get the information provided to us. The company's unlevered cost of capital is 12%. So we can actually calculate now already a firm value. How? Well, the value of a firm equals the present value of all future free cash flows. So let me go back. The company will generate $48 million of after-tax cash flows. Wait, I need to close the door. Sorry, guy. Oh, damn. Thanks, baby. 48 million after-tax cash flows per year. So every year I will earn 48 million. And I'm discounting, as you can see, with the unlevered cost of capital. Why unlevered? Unlevered simply means there's no debt. And this is indeed an all-equity firm. So yeah, I have to discount with the unlevered cost of capital. Why do I discount in this way? Why do I not write brackets 1 plus 12% to the power of 1, 2, 3, whatever? Because the company is expected to generate these free cash flows in perpetuity, forever. So I'm simply discounting here a perpetuity. The same cash flow forever, I divide simply by the discount rate, and that is the present value. So the value of the company at this point is $400 million US. But there's more. This is just the earnings situation of the future. the company also already now has 20 million excess cash. So what is the value of the firm as it is right now? Well, it is the 400 million, that's the present value of all the future earnings, plus the 20 million we already have literally in the bank. So our starting point before we hop in the three scenarios is the company has a value of $420 million. Again, brief side note, just a reality check. How seriously should we take these numbers? Well, maybe not as much. Why? Because how realistic is it to say we will earn exactly this cash flow every year forever? Inflation is not considered. New competitors are not considered. Changing consumer taste is not considered. Imagine this is a company in Europe, or maybe better example, this could be a Chinese company, and we could be 3 years ago under President Trump. Our Chinese company might do a lot of business with America, the United States. When they had Trump, Trump started a trade war with China. All of this would impact our future earnings, okay? So please don't make the mistake of assuming that this is really a hard number and you can do this and figure out accurate results, okay? Be skeptical about these things. But everyone is on board. Question. Everyone is on board how I got the 420 million. It's our starting point in each scenario, so we need to already agree on this. Is everybody on board? Also on YouTube? If not, yeah, super. If not, please keep an eye on the YouTube chat and immediately yell at me if there is a question that is relevant for our starting point. Okay. What are we gonna do? Well, imagine now that the management wants to pay out the 20 million in excess cash to the shareholders in some fashion. It wants to do something that will benefit the shareholders. What are the options? Well, no surprise there. 1, 2, 3. Option number 1. Pay out the 20 million in excess cash as a dividend, as a cash dividend. Sort of get rid of it, put it in the pocket of the shareholders. Option number 2. Use the 20 million in excess cash to buy back shares. Not shares of some other company, but this company could buy back its own shares to reduce the number of shares outstanding. And option number 3, the company could say, and that's really weird now, they could say, no, we want to pay out dividends, but not just the 20 million. We want to pay out dividends at an amount that is bigger than 20 million cash. I'm sorry, I need to let James out. Sorry. Yeah, come, Jamesy. Come. Yeah, hush. Yeah. Sorry, guys. I'm sorry, James. So obviously with option 3, that's kind of bizarre because we say, well, dividend policy is a residual. We have 20 million cash that we could pay out. And now we end up actually considering an extreme scenario. We want to pay out more than we have. So obviously, if we want to pay more out than we have, we immediately need to think, oh, yeah, but how are we going to finance this? Okay. So these are the 3 scenarios that we will go through. I don't have a scenario 4 that goes along the lines of, which is a real life scenario. Let's leave the money in the firm because maybe investment opportunities will pop up in the future that we then immediately can follow up on. The reason why we are not going to discuss this is there's nothing to discuss. Then you would say, I'll leave the money in the company and wait and see what happens, okay? So that's why we don't look at this. And what we will do, we go now and calculate the share price of this firm in each of the 3 scenarios and then compare and see, is any of the options better from the shareholder perspective than the others? And we start with scenario 1, which is the company could say we pay out the whole $20 million in excess cash as a dividend. So I'm gonna make now just a logical argument step by step. So if we pay out all the 20 million that we have in excess cash as a dividend to the shareholders, each of the 10 million shares outstanding, that's the number of shares outstanding we have, will receive $2 right away. Obviously, we have 10 million shares in circulation, 20 million cash. How much does each share get? 20 million divided by 10 million. $20 million, I should be more accurate, $20 million divided by 10 million number of shares. Everybody will get a cash dividend of $2 per share. Under the current forecasts and all other things equal, brief side note, this here should set all your alarm bells off. how likely is this gonna hold in the real world? Not, okay? But for now we assume this. Current forecasts, everything else unchanged, everything else equal for all future years. Again, think about what does this mean in the real world. Shareholders can expect $4.80 dividends per year. How did I figure this out? Well, the $2 is just the dividend per share based on the amount of excess cash we have. But of course we will continue to operate, and we have that was given to us, that the forecast says every year this company will generate after-tax cash flows of $48 million. So how much are the future dividends gonna be? $48 million per year that we are expecting to earn forever, divided by the 10 million shares outstanding. So that means if you are my shareholders, what does this scenario mean for you? I give you $2 right away. If you're assuming you have one of the shares only, you get $2. And then in every subsequent year, you will get $4.80. Now, in order to understand this, it makes sense to have a timeline to basically, like in a net present value calculation, sketch out when does a cash flow occur and how high will it be. So that is the timeline. There are a couple of important dates here. I'm explaining them on the slides, of course, as well. We have a declaration date. That is the date where the company informs the shareholders that yes, there will be a dividend for you. We have a so-called cum dividend date and a so-called ex-dividend date. I don't know if you had Latin in school, but there are very important words in Latin. Cum in Latin means with. So that means with dividend date, and ex in Latin means a million different things. In this context, ex means without. So we have here two dates that in normal language would be called with dividend date and without dividend date. And in very simple language, what these dates are, if you are not a shareholder yet, but you buy a share before or including the cum dividend date, you're still eligible to get the dividend. Whereas on the ex-dividend date, if you buy the stock, if you become a shareholder on ex-dividend date or after, you will not be eligible for the current dividend, only then from next year on. Okay? So it's just a couple of technicalities here. Then of course there's a recording date where you make your accounting entries, and then there's an actual date where the company really pays, the payment date. How would this be in our specific case now? That's just the explanation of what I've just mentioned. How will this play out in scenario one where we pay out the 20 million cash? Let's look at it. Like I said, you need a timeline. What will happen in a perfect world, perfect capital markets, around the ex-dividend date? So this is a timeline. You see it's a bit interrupted. I'll explain, of course, in a second more. It's a timeline. This is basically, let's say, the ex-dividend date. This is before the ex-dividend date, and this is after the ex-dividend date. And what I'm plotting here essentially is stock price. So what would happen on the ex-dividend date? So we would see the stock price. If everything else is the same, the stock price would be a flat line, no changes. But what would happen then on the ex-dividend date? On the date where if you were to become a new shareholder, you would not get this dividend anymore. On the ex-dividend date, the price drops, the share price of our firm, of this firm that we're considering, drops exactly by the amount of the cash dividend. And this, a lot of you ask, Modigliani Miller, how does this hold up in the real world? And usually I say, well, take it with a grain of salt because of all our assumptions. This here is something you can see with literally every single firm. Okay, this drop on the dividend date. So feel free after class to type in whatever, firm, stock price, ex-dividend date, something like this. You see this sharp decrease. It's obvious. When you do this, very advanced now, but I still want to tell you, and it's, if you're not about finance, if you don't want to do a finance master, check out for a minute or two. If you are interested in finance, this is a very cool topic where you can actually think about doing a master thesis about. When you do research that involves stock prices, you cannot simply treat them as, well, that is the stock price. You always, in order to analyze stock price movements, you need to correct for this drop on the dividend date. Otherwise, all your results will be seriously distorted. So you then conclude, ooh, something happened here, this firm is performing worse. Has nothing to do with this. It's a mathematical artifact because the excess cash is now gone. Logically, the stock price drops. So if you do a master thesis in finance later on and something involving stock prices, make a mental note, you need to consider that on the ex-dividend date, the stock price always drops by the amount of the dividends, okay? End of the side note. Okay, let's continue our analysis. So what will happen? Just before the ex-dividend date, the shares are traded cum dividend. Like I said, cum is the Latin word for with. So that means the share price, I don't want to say is inflated, but the share price still contains the part that is made up by the dividends that I, the manager, am about to pay out. So before the ex-dividend date, the shares are traded cum dividend, so with the dividend, because everybody who has shares before the ex-dividend date is eligible to receive them, yeah? Entitled to receive. So what should the share price then be? And again, don't be weirded out by this mathematical notation. It's really relatively straightforward. We're trying to calculate now the stock price, but we need to be more accurate. We are calculating now the stock price cum dividend. How is it calculated? Well, the net income, so that would be the dividend right now, plus the present value of the future dividends. Now, easy enough. Let's fill in numbers. What is the cum dividend price? The cash dividend that I pay immediately to you right now from the 20 million in excess cash, that's the $2 per share we have calculated, plus we said based on our future earnings forecasts, every shareholder will receive in the future each year $4.80 in each year. But that happens in the future. The $2, that will happen right now. That's why this is already a present value. You see that I'm not discounting. The $4.80 will occur every year forever. That's why I'm discounting with 12%. Well, the unlevered cost of equity. And I discount a perpetuity. This is just discounting a perpetuity again. So I calculate then what is the sum of the present value of the dividend I pay right now and the present value of all the future dividends, $42. What does this mean? It means that just before the ex-dividend date, the share price should be $42. What else happens? On the ex-dividend date, the shares, not the shares, I should say here the share price will drop. But how much will it drop? Well, on the ex-dividend date, X means without in this context, so the dividend will basically mentally be deducted. The share price should drop by exactly this amount, the $2 that I pay right now, that are the same $2 here. This will be gone. So what will then the share price be on the ex-dividend date and after? Well, only the second part of our calculation, only the present value of all the future dividends, not what we have already paid out. So we have calculated the cum dividend price as $42, and now we calculate the ex-dividend price. So after the dividend basically has been deducted. It's only the second part, present value of the future dividends. Everything else is the same. And we conclude, okay, on the ex-dividend date, the share price should drop by the amount of the dividends. Boom, from 42, it would drop to 40. That's what you see here, -2. Again, check out real stock price charts around the dividend date and see how the stock price moves. Okay, that's a very nice argument, I think, to show that this really happens.
Can I have a question?
Absolutely, go.
So the price cum is before the ex-dividend, yeah?
That's correct.
Okay, thank you.
Oh, yeah, that's it, yes. Yeah. We already can turn to scenario 2. The point of, maybe I want to stress a bit what the point now is. So we have analyzed now what is the cum dividend price, what's the ex-dividend price. And for the time being, we put this in the back of our head so that when we have done this for scenario 2 and 3 as well, we can compare them and then make up our mind what it all means. Okay? For the time being, let's leave it as is. Cum dividend price 42, ex-dividend price 40. We move to scenario 2. What is scenario 2? Use the 20 million in excess cash to buy back shares. Again, don't picture here that the firm is investing in the shares of some other company. No, this company means then we take the 20 million and buy back our own shares, reducing the number of shares outstanding, our own shares, okay? That's what this means. Now again, let's analyze. So the initial share price we have calculated would be $42. Brief refresher, how did we get this? Initially we said the firm value, let me go back, just that you can connect this nicely. Oops. The initial share price was, the initial firm value was, we calculated 400 million, the present value of the future earnings, plus the 20 million we have in cash. So our starting firm value was 420 million. That's what I'm referencing now. Where is it? Da. So if we have a firm value, total firm value of 420 million, that is spread out over 10 million shares, what should the share price be? $42. Then we have to ask ourselves, well, if the company has 20 million excess cash, how many of its own shares can it afford to buy? We have 20 million excess cash. We know that one of our shares is traded for $42. So I simply type this in my calculator and I find out we can afford to buy 0.476 million shares or 476,000 shares. So that means if we go through with strategy 2, the number of shares outstanding will decrease because we buy them back. It will decrease from 10 million shares outstanding to 10 million shares outstanding minus this here. So what will be the new number of shares outstanding? I've done the calculation here. It will be 9.524 million. Again, remind yourself why the number of shares outstanding goes down. That is the strategy we're analyzing, a share buyback, a firm buying back its own shares to reduce the number of shares outstanding. And the idea of that, why would you do this anyway? The idea of that is, we have excess cash now that we cannot use in any other meaningful way. There are no investment opportunities. If we use the cash now to buy back our own shares, to reduce the number of shares outstanding, all future earnings will be divided over a lower number of shares outstanding, benefiting the shareholders that still have the shares. That's the idea. Okay, we have to, of course, now figure out what will be the share price after our buyback. So after our firm bought a certain number of the 10 million shares outstanding, bought them back and reduces the number of shares outstanding. What will be the new share price then? Let's look at it. So if we buy back our shares, obviously we will only buy a fraction of them. What was it, roughly 400,000 shares, something like this. So that means that after the buyback we still have a lot of shares in circulation, 9 point something million. So the remaining shareholders, everybody who has not sold their shares to us, is entitled to receive the future cash flows of our company. It was given to us that our forecast says we expect earnings, future earnings, forever of 48 million in after-tax cash flows each and every year. This needs to go into our calculation. What will be then the dividend per share in the future? Well, the company earns or expects to earn $48 million. How much, what does this mean for the future dividends per share? Before we divided by 10 million because we had 10 million shares outstanding, but now it's of course less because we're doing a share buyback. So we have 48 million every year for the infinite future, divided only over roughly 9.5 million shares. So what does this mean? The future dividend per share will actually increase. It will increase to $4.04. Brief sidebar, question, is everyone on board? Nobody has checked out yet. Everyone is still on board. Especially guys, if you're on Zoom.
I'll ask you a question.
Yeah, shoot.
When you use the 20 million to buy back shares,
Mm-hmm.
the value of the firm will decrease, right? So is the share price not already decreased?
Yeah, that's a bit part of our consideration now that we figure out how everything changes. Okay? So that's really the point of this operation to figure that out. Okay? Just a bit more patience. Almost there. So first, logically, if we reduce the number of shares outstanding and if our future earnings remain constant as expected, as forecast, then the future dividend per share per year should be $5.04. What should be then the correct, whatever that means, share price after the repurchase? Well, the price after the repurchase should be the future dividends, or let me say it more specifically, what should be the price of the shares after the repurchase? It should be the present value of the future dividends. No change there. But the future dividends have now increased to $5.04. We still discount with our unlevered cost of equity. Still an all equity firm, no changes there. So what should be the price after the repurchase? $42. Okay, what does this mean? I mean, I just have to point this out really now. So maybe surprisingly, the share price will remain unchanged at $42 even after the share repurchase. Okay, no change there. The only thing that has happened is that the future dividend has increased, but as we see, if we do a present value calculation, it will not impact the actual share price. And we're already in scenario 3. Don't worry, in the end, I have a slide where I put everything next to each other that we can compare this a bit. What was scenario 3? We said the company could say, let's not just pay out the excess cash, the 20 million, but let's check what happens if we pay out more than the 20 million in excess cash that we have. So I need to clarify a little bit what we mean. The company says we may, or we decide to pay out a higher amount of dividends, more than the $2 per share. Remember, the $2 per share come from, initially we have 10 million shares, and we have 20 million excess cash. So that would mean an immediate cash dividend of $2 per share. That's the $2. The question is, as always, as in the two cases before, will this increase in the dividend, will it benefit the shareholders? Will, after this move, the shareholders be better off? So the company has, from next year onwards, 48 million available for the dividend payments every year. There's no change there. That's why we also said before, Modigliani Miller, proposition 3, under the assumption that we keep the investment policy fixed. That's why everything is unchanged here. Imagine now, we need to clarify how much more does the company want to pay out. Well, the company wants to pay out already the future earnings right now. So the company says, therefore, we want to pay a total dividend of 48 million to the shareholders already this year, not starting next year, already now. We only have $2 available now in excess cash, but we already want to basically anticipate our increase in future earnings and start with a higher dividend right on the spot. But the problem, the starting point of scenario 3 is we only have 20 million, yet we need more. We need to pay out 48 million. So we clearly have a delta, a difference, a gap of the 48 million that we want to pay out now already, but we only have 20 million. So the gap that we have is 28 million here. Okay, that's the 28 million. The company needs an additional 28 million to be able to pay out total dividend to all the shares of 48 million. This is now, again, we have to, I don't want to say make assumptions. We have to make up our mind which scenario we want to analyze. We have to acknowledge the company could raise this amount, the 28 million that are currently missing for our desired higher dividend payment. They could either raise equity, so sell more shares, or they could raise some debt. Either way, somehow the 28 million need to be financed. Just for the sake of this example, and you see it stylized, we are now assuming that the firm will raise equity. Okay, so the current share price at the beginning of our consideration is $42. The company wants to raise another 28 million. So how many shares would they have to issue? Remember, we now consider how this plays out under the assumption that the company wants to remain all equity and therefore finances the 28 million with equity, meaning the company has to issue and sell new shares. So this would mean the number of shares increases. So it's like the opposite of a share buyback. We issue more. This, you might want to make a note. If you do something like this in the real world, you already are a publicly listed firm and then you issue more shares. This is not an IPO. This is not an initial public offering because you already are trading your equity. This is called an seasoned offering, SPO, seasoned public offering. Okay? Okay, so how many shares do we have to issue to raise $28 million? Well, if the share price per share is 42, then we have $28 million divided by a price per share of $42, and that gives us, we need to issue 0.67 million new shares. So this is the amount by which we will have now more shares outstanding. Not just 10 million, but 10 million plus this. Sorry. What does this mean now? How will this impact the future dividends? Well, we have now not only 10 million shares outstanding, but 10.67 million. There are a number of shares. What will be the dividend per share? 48 million. Sorry, I'm noticing now I'm being inaccurate here. I should have written here dollars. That is a dollar amount, okay? $48 million divided by 10.6 million number of shares outstanding equals $4.50 per share. Almost done, guys. We're really almost done.
Sorry, could I have a quick question?
Of course.
Could you go back first?
Oh, yeah. Yep.
Yeah, from what we get this, the company needs an additional 28 million. Because, yeah, I don't understand when this number came up.
Okay, then let me go all the way back to the front. Bloop, 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 bloop. Nee. So, this was the first slide of this example where we get informed about basically the whole setting, the whole framework of this firm. Company has 20 million in cash right now, and we are analyzing what to do with it. The most obvious answer would be invested in a positive net present value opportunity. But it's not possible because it's defined here that the company has no investment opportunities available. Okay? The net income available after undertaking all positive net present value opportunities. So that means the 20 million we cannot use for investing in growing our business at all. That's why we are wondering what to do with it. It's further specified that from next year onward, expects to generate free cash flows of 48 million. But for the future, for all subsequent years. Not this year, only next year. And in scenario 3, we are now saying the company wants to pay out the 20 million, but not only the 20 million. The company wants to basically give shareholders a taste of how awesome the dividends are going to be from next year onwards, where the company could afford to pay out this year the 48 million every year. So if the company says, I already want to give my shareholders the dividend that from next year on they will earn, but already this year, then the company needs to think of how can they pay now, already this year, before those future earnings will occur. How can the firm pay out $48 million in dividends? They only have 20 million. So how much, Philip, you tell me, how much is missing?
Yeah, 28, thank you.
Yeah, perfect. Amazing. Yeah, super. All right. Boop, 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 boop. Where are we? So, yes, share price 450 per share. The number of shares has increased and we need to basically already tie this up neatly together. So we have discussed this. As a consequence of the drop in expected dividends per share, the cum dividend price becomes. So that's the price with the dividends. Cum means with in Latin. What is the price cum dividend? It is the dividends right now, plus, that's a present value of course already, plus the present value of all the future dividends. And based on the fact that this year already we will pay out the earnings that we expect next year, so basically the 48 million already this year, we have a dividend now of 450. Let me go back one slide. It's this year, the 450. Plus, dividends in the future will also be 450 that will occur every single year forever. So that are all future values I need to discount because they will occur forever. I discount with the unlevered cost of equity as a perpetuity. That's why I'm dividing by 0.12 and not by 1 plus 0.12 to the power of time. I press it in, type it in my calculator, and I find the cum dividend price should be $42. So what does this mean? Paying out an additional dividend for which we have to use external financing will deliver no value to the shareholders. And now we need to look at an overview because I cannot keep all the numbers in my head at the same time. So let's look at it. So this is a table that presents the overview of all the stuff that we have gone through. Policy 1, Policy 2, Policy 3. And we simply compare this. So our initial share price in every scenario was the same, $42. Yeah?
But just as a thought experiment, what would happen, for example, if we got like really good conditions from our bank?
Yeah?
And for example, would get the 28 million for interest of 0.5%. Wouldn't it be like beneficial if we benefit more from the dividend value?
Yeah, I mean you're making a good point, but the moment, so first of all, in this setting, in this world that we are talking about, it would not make a difference. It would in the real world make a huge difference because, of course, interest payments, from our perspective, interest expenses, generate for us something very nice. The infamous tax shield, which indeed can create value, right? Think trade-off theory, we get initially a value increase, especially this firm, which is an all-equity firm, so they can easily digest some degree of debt. But why would it generate a tax advantage? Because you have already in your mind, which I really love that you did, you already start to relax the assumptions. You already say, now wait a second, but there are taxes in the real world. And then of course, the situation might change. So what you are doing now, your comment, you're already a couple of steps ahead of me, talking and thinking about why are there dividends in the real world? Okay, so a little bit more patience. You're absolutely right in principle that debt financing could make a difference, but only because you already relaxed assumptions. Okay?
And here, thank you, and here we kind of stick to the initial idea that we're an all-equity firm, and therefore the only possibility which we use is raising or offering shares and not debt finance.
Yes.
That's just assumption we have.
Yeah, that's simply part of the exercise thought experiment. We're looking at an all-equity firm for starters. If we were to look at that, it would make the example more complicated. And if we still operate in a world without taxes anyway, it's kind of uninteresting, really. What you have said has absolute merit. The moment we start relaxing assumptions, we will indeed talk about your point. Absolutely. Yeah.
All right. Indeed makes sense.
Yeah?
May I also ask a question?
Of course.
Wondering because now we're looking at what it was in cum prices. So before people don't even get the dividend anymore, but afterwards, in the dividend cases, the term value decreases. While when you buy back the shares, it will not decrease in the future. So isn't it not better than to pay out dividends because to like buy back shares because then the share price won't drop at the X date?
I mean, it's a good point. What you are basically asking me is, so what is the conclusion of all of this? And that's exactly what I want to talk about. So it's a good question, don't get me wrong, but that's exactly what we are discussing now, okay? So the starting point in each scenario, policy 1, 2, 3, the starting point was always the same. The firm as it is described now, with a share price of 42. And then in the different scenarios, different cash flows from the shareholder, from your perspective, will occur. So we have here what happens right now, that's year 0, so T0, that's now. Next year, in 2 years, in 3 years, and so on. Let's compare this. So in scenario 1, at T0, so scenario 1 was, we have 20 million cash, and the firm pays out the 20 million cash to the shareholders, not more, not less. What happens then? The shareholders get right now a cash dividend of $2 per share. What will happen in the future? In the future, we will observe cash dividends per share of $4.80. In policy 2, starting price was also 42. In year 0, nothing will happen Because policy 2, if you remember, was the share buyback, where we reduce the number of shares outstanding. So we don't pay out the excess cash, the 20 million, as a dividend. That's why we have a 0 here. You don't get cash from me, sorry. But the future share price, the future dividends will be higher because number of shares outstanding has decreased. And policy 3, starting point was an initial share price of $42. Policy 3 was, not only do we pay out the 20 million in excess cash right away, we pay more out than the 20 million, we pay out 48 million. So to give shareholders already a taste of the things to come from next year on, we had to finance this with more equity, meaning our number of shares outstanding went up. What does it mean? You immediately get a higher dividend, higher than the $2 in policy 1, and it will in fact be the same dividend every year. What does this now mean? And this is really the key here, so you might want to make 5 exclamation marks in your notes. What does this trade-off illustrate? Again, trade-off simply means you get something very beneficial, but it will have future disadvantages and vice versa. You accept something less good right now in order that the future will be even better. So you have to weigh certain benefits and costs, if you will, advantages and disadvantages. So this trade-off here ideally illustrates that increases in the current dividends per share will come at the expense of future dividends per share. As you can see here, if you want a very high future dividend, wait, I wanna sketch this out. So let's say your shareholders and your mindset is, I want in the future very, very high dividends. Now, okay, we can do this. Very high dividends would be this. In our scenario, that's the highest dividend you can get. If you say, I desire high dividends in the future, I can give that to you. What's the trade-off now? No dividend right now, nothing. If you say, I would like a very high dividend right now, what's the highest dividend I can give you right now in these 3 policies? Well, $4.50, I can give that to you. High dividend now. What is the trade-off now? The future dividend will be the lowest in all the 3 policies. And if you say, I want to go for some sort of compromise in between, a little bit of a cash flow right now, and an okay dividend later on, now, I can also do that. I give you a medium dividend now, $2. As you see, the future dividend will also be a little bit lower than in policy 2, but you already get something now. So, okay, where does this leave us? The net effect is that the size of the dividend does not matter for the share price. You have seen the share price was the same in every scenario under each policy. So what does this mean? It doesn't matter what I do with the dividends, I as a firm. I can give you a lot of money right now. The consequence is you get less money in the future. I can give you a lot of money in the future. The consequence is you don't get any money right now. And I can say in the future I give you sort of a medium amount of money. What's the consequence for now? You also get a medium amount of money now. So it's really a matter of timing, but at the end of the day, in Modigliani-Miller world, none of this would matter. None of this matters because it is simply a question of rearranging when the benefits occur, earlier or later, but it is a zero-sum game at the end of the day. Under perfect capital markets, we're almost done, by the way. Let me see briefly. Super. Let's finish homemade dividends very briefly and then we're done for the day. In our second lecture this week, we wrap up this slide set a couple of interesting theories to explain how do dividends in the real world work then. And then we're done with capital structure perfectly. Under perfect capital markets, through the concept of homemade dividends, again, super easy, you'll see, investors can synthetically, artificially enhance or lower the payout to whichever level they desire. It doesn't matter what the firm does. If you want a dividend now and the firm doesn't pay it out, you can create it yourself as a shareholder and vice versa. We call this homemade dividend. It's an incredibly straightforward approach. What is the core idea of homemade dividends? If the company currently has a dividend policy, but your preference, as a shareholder, your preference is a different timing or a different size of the payouts of the dividends, you can attain the desired timing or size by buying or selling stocks. This sounds maybe very abstract. What am I saying? I need to show you in an example very briefly. It's the briefest of examples. Let me show you. It's 2 slides. Whoops. Imagine that's you. We are looking at an investor. You have in your portfolio 100 shares of a specific firm. The shares are currently trading at $42. We are expecting that the firm will pay a dividend of $2 per share next year. You, however, have a different preference. What you want is, you want to have a larger dividend than the $2 per share. You want $4 per share. How can you do this? How can you achieve, sorry that I only wrote here his, I'll fix it. How can you do this? It's incredibly easy. I will show you, and I'm a bit embarrassed that I have such a complicated sounding term for that. So what is your current wealth? You have 100 shares, and each share has a market value, a share price right now of $42. So what's your wealth? Multiply 100 times 42 gives you a total investor wealth of $4,200. After any dividend payout, your wealth will be unchanged, still $4,200. But why? Because first, what will immediately happen? First, you will receive dividends. The company, by default, that's what the company has declared, will pay out $2 of dividends per share. How many shares do you have? Well, 100. So that means you will receive a dividend of $200. What else happens? Well, the moment the company pays out a dividend of $2, what will happen on the ex-dividend date? Boop, the share price will go down by the amount of the dividends paid. So the share price will decrease from $42 by the amount of the dividends paid by $2. So it will go down from 42 by $2 to $40. So what does that mean? After the ex-dividend date, the value of your portfolio has actually gone down because you still have 100 shares, but the value of each share has decreased from 42 to 40. So the portfolio that you're still holding, unchanged, has now a value of only $4,000. Are you now better off or worse off? No change, equal. Only the composition of your wealth has changed. Initially you had 100 shares, each share worth $42, your total wealth, and you had 0 cash in your pocket. The total wealth that you had was $4,200. After the dividend would be paid out, the $2, your share portfolio would have a reduced value from $4,200 to $4,000, but you're not worse off because now you have $200 in cold hard cash in your pocket. So what's your total wealth after the dividend? The 200 cash in your pocket, plus still the 100 shares that are now traded at a slightly lower stock price. But you're neither better nor worse off. The composition of your wealth has changed slightly. But part of this example is, of course, that you want more, right? That was given here. You want more. You prefer to have a larger dividend. How much? You don't want just the $2 per share, you want $4 per share. So let me now show you the sophisticated concept of homemade dividends. How can you do this? Prepare to be slightly underwhelmed. How can you create an artificially higher dividend? This will blow your mind. You could simply sell 5 of your ex-dividend stocks. Ex means without, so that means after the price of the shares has already gone down to 40. Naja, okay, you could sell 5 of your shares because you want a higher dividend, right? You don't just want, let me go back, the $2 per share, you want $4 per share. You hold 100 shares yourself, so clearly the dividend that you desire is not just the 200, but 400. So how many shares would you have to sell to get a cash inflow of 400? Well, after the dividend was paid, the share price drops to 40. That's the ex-dividend date. And you need artificially to raise 200 more because that's what you want, 400. So 200 divided by a share price of 40 means you have to sell 5 of your shares so that you get the extra income on top of the 200 dividend, another 200 so that you end up on the level of cash flow 400 that you really want. Okay, easy enough. So you sell then 5 shares after the dividend was paid. That's why we have the lower share price here. How much cash do you have in your pocket now? 400. The 200 dividend that the company wanted to pay out anyway, plus the 200 from selling these 5 shares, these 5 stocks. So in your pocket, you will have 400 cash, which is exactly what you wanted. But how has your overall wealth changed? You have now sold off some of your shares. Are you now better off or worse off? Let's see. The value of your portfolio, of the actual shares you hold, has gone down now because you have now only 95 shares left. Remember, you just sold 5. Okay. You sell, initially you had 100 shares. Then you sell 5. How many do you have left? The 95 here. The dividend has been paid. We are ex-dividend. The share price therefore has gone down by the amount of the dividends. That's why we have now a share price of 40. That's the 40 here. So what's the value of your portfolio of the shares that you still hold on to? You still have 95 shares and each share has an ex-dividend price of 40. So the value of your portfolio is 3,800. Are you now worse off? No. Sure, the wealth that is tied up in the form of your share package, of your share portfolio, is less, but in your pocket you have now 400 euro in cold hard cash, right? That's the 200 that we paid out, that the firm paid out in dividends, plus the 200 from selling the 5 shares. So what's your total wealth if you do this? Still 4,200. 400 in cold hard cash, of which 200 are dividends that the firm would have paid anyway, and another 200 simply from selling 5 shares. What have you effectively achieved? You have effectively achieved a higher cash flow, a cash flow of 400, twice as much as the company would have paid out in dividends by pulling off the concept that we call homemade dividends. What does homemade dividends mean? If the company does not pay out dividends high enough for your taste, for your preference, you can artificially increase the cash flow, the cash inflow. How? Homemade dividends simply means you sell some of your shares. Let's do the other side quickly.
Can I?
Yes? Yes, yes, yes.
I don't understand how we get to the 5 shares.
Aha, I can help. No worries, I can help. How do we get to the 5 shares? That has to do with, wait, I need to get rid of this. No. Save. Okay, let me show you. That is part of basically the description. It was given to us that you as the investor, you want to receive 400. The company only has a cash dividend for you of 200. So you want 400, 200 the company will pay out anyway, but you need more. How much more? Another 200, right? Okay, but how should you get those extra $200? You simply sell some of the stocks that you have. So the question now is, how many stocks do you have to sell to raise the extra 200? So the 200 on top of the 200 dividends that you need to get to the cash inflow you want of 400. The share price, the ex-dividend share price is $40 and you want to finance an extra cash inflow of 200. So how many shares at a price of 40 do you have to sell so that you end up with a cash inflow of 200? Well, 5 shares. Does it make sense, Alice?
Yeah, thank you.
You're most welcome, of course. I'm on the, yeah. Okay, so what does this mean? Irrelevant what the company does, if they don't pay out the dividends, then the share price will be comparatively high. If you want the dividends, extra cash inflow, I should probably say, then just sell some of your shares. And because it's finance, let's give this a fancy term. Let's give the following action, the following decision, a complicated sounding term. A shareholder wants more dividends, wants more cash inflow than what the company pays out in dividends. How can he, she, or they achieve this? By selling some of their shares. And let's call this by a fancy name. Let's call it homemade dividends. That's what it is. Let me quickly show you the opposite. Let's say the company says, we pay out a dividend of 400, yet you don't want a dividend of 400, you only want 200. Maybe because the extra 200 would push you in a higher tax bracket or something like this. What could you do if the dividend is too high for your taste? How does homemade dividends look then? It's the opposite. If the company pays you dividends of more than what you want, then simply take the money that you don't want and buy more of the shares. That's homemade dividends. I'm not making this up, it's real. Okay? This is it. This is it, guys. Homemade dividends is really the perfect example for finance people making it needlessly complicated by giving fancy terms to relatively straightforward concepts. A shareholder that does not get a dividend that is high enough for their taste simply sells off parts of their share portfolio to get to the cash inflow level that they want. If, however, the opposite happens, the dividend payment that the shareholder gets is too high for their preference, they simply take these dividend payments and buy more of the shares. But in either scenario, it doesn't matter, because the only thing changing is the composition of your wealth. How much is tied up in a share portfolio versus how much cold hard cash is in your pocket. It's just reshuffling. In the Modigliani-Miller world, in the real world, this this is definitely different, because the assumptions of Modigliani-Miller do not hold in the real world. So I can already tell you, the moment we relax the assumption of no taxes, this will be very different, okay? So, brief outlook for what is going to happen in our next lecture this week. We stop being in a Modigliani-Miller world, we move into the real world and relax assumptions and discuss what's going on in the real world. And I want to end on the following note. After today's lecture, the moment we hang up, you should basically start thinking, wait a second, he basically just made a 2-hour argument that dividends don't matter at all. High, low, if they are paid out or not at all. None of this should matter, because a shareholder can do artificially, synthetically, homemade anything they want. Then you immediately must say, wait a second, I don't buy that story. If I look at the newspapers, at share information, the newspaper headlines are full with shareholders are unhappy, the company again doesn't pay dividends. So very clearly something is missing, or very clearly there's a difference between Modigliani-Miller world and the real world. So in our next lecture, I will explain, hopefully in a convincing and clear way, why dividends do matter in the real world. Okay? So this is a preliminary in-between conclusion. We have reached sort of a first safe point. We need to add now, how does this really work in the real world? Not like this. In the real world, there are all kinds of frictions, taxation and so on, that have a big impact. So the next lecture there will be not a single number, I think, at all. I will introduce you to a couple of theories, a couple of ideas to transition successfully from Modigliani-Miller world to the real world in our dividend considerations. That is it, guys. That is the story for the day. Any questions? Anything I need to explain again? Anything that was unclear or anything else?
Thank you.
You're most welcome. Don't be shy. If there are questions, let me check YouTube. Yeah?
I have a question.
Shoot.
Can you go back to the homemade leverage slide?
Homemade dividends. Homemade dividends.
Yeah,
Or,
homemade dividends.
yeah. Well,
Yes. What we did, right, was like to create that extra 200, selling the shares. Yes.
Yes.
Basically, selling the company's shares. But in that case, wouldn't like for the next dividend period, our like would like the value be lower since we sold some of our shares?
I see your point. It's a very good point you're raising. How would that impact then the future? Because, well, the moment I sell, where is it? The moment I sell 5 shares, right now the cash flows are now as we want them, but selling 5 shares will have implications for the future because now clearly I have a lower amount of shares. So if these shares earn a dividend and I have less of them, my future cash flow will be impaired. You're absolutely right. But we cannot really continue this conversation or this argument much further because it depends, of course, what you do with the 200 in your pocket, right? So this comparison is almost a bit unfair now because you have now 200 euro in cold hard cash in your pocket with which you would do something. So continuing this thought experiment does not really make much sense because we don't really know what you want to do with the 200. The main point that this should illustrate is that right now, no matter how high or low the dividends are that the company pays, you can change this artificially by either selling shares or buying shares. How the future is impacted by this, we cannot derive from this example, simply because it would matter for this what you do with the cash that you get. Okay? Guys, anything else I can do for you at this point? Excellent. Thanks for joining as always. I see you. Oh, no, bring it.
When we were calculating the share price in scenario 2, we had to calculate what is the new share price after shareholders buy back the shares. I don't really understand the calculation of the price repurchase. Like I see where the $5 come from.
So sorry. Wait. You said now scenario 2? There is no. I'm not really sure what you're. Are you talking about the previous example?
Leverage was about the previous example.
Guys, I'm sorry. This is now the third time that somebody said this wrong. Do not ever confuse homemade leverage with homemade dividends. I know homemade dividends is now a new concept. Leverage is the mix of debt to equity on the right side of the balance sheet. This is homemade dividends, okay? I've seen many exams where students, we asked about something like that on the exam. Perfect textbook answer, but consistently using the wrong term, leverage instead of dividends or vice versa. I still gave some points, even though it's technically, of course, grossly wrong. Please be careful with this. I know we have so far talked about homemade leverage, but this is a second thing. Homemade leverage is different from homemade dividends, okay? Sorry, but that was very important to me. You said, what do you not understand? Which aspect?
Yeah, it was about the previous example before the homemade dividends. When we were calculating scenario 2.
Scenario 2, wait a second. Whoop, yeah.
Yes, after this slide.
Yeah.
So I see where the $5 come from, the dividend per share, but I don't understand why we're calculating the correct share price again, the price repurchase, like the $42.
I need to get this here. You mean this calculation?
Yes.
Where this is coming from? Okay, so this here means the price after the repurchase. We're asking what is the impact of this kind of policy? What is it gonna be? Well, what we have done is we have calculated first, or let me start differently. The logic of this calculation is that we say the price of a company should be the present value of its future earnings, roughly. From the shareholder perspective, what should be a share price? Well, it should be the present value of all the future dividends. So what we are setting up here is a present value calculation, discounting all the future dividends. So your question breaks down into several sub-questions. What is this calculation about? Then I need to explain first this here. Where do the $5.04 come from? Well, after the share repurchase, the company will not have 10 million shares outstanding, but fewer, because that's the point. We buy back our own shares. So after the share buyback, we only have 9.524 million shares outstanding. But our investment policy is fixed, so we will still, after next year, still every year earn forever $48 million. So what will be then the future dividend per share? $48 million, from next year on, future earnings, divided by 9.5 million shares. And if I calculate this, I find that the share price should be $5.04. So that's this year, okay? This calculation gives us the $5.04. So that will be then the future earnings per share. The 48 million are the earnings that the firm has available to distribute amongst the shareholders. And the 9.524 million is number of shares outstanding. So the future earnings, the 48 million in the future from next year on, will be divided over 9.5 million shares. And that means that the share price, the dividend per share will be 5.04 forever, every year. And that's why I'm discounting like a perpetuity with the unlevered cost of equity that was given to us, 12%, to find what is the share price gonna be after the repurchase, $42. So that is the train of thought here. Is it clear, Marie?
Yes, thank you.
You're most welcome. Guys, any other questions? Perfect. Guys, thanks for your attention. Thanks for your questions. I really appreciate it. Like I said, the worst is behind you. Hang in there a little bit longer, okay? Have a great day, and I see you, I think on Wednesday is our next lecture, if I'm not completely wrong. Have a lovely day. See you soon.
Thank you, bye.
See you guys. Doei doei.